Hi, I'm Tristan Jacoby, partner at Creative Wealth Management, here to discuss opportunity amid stubborn inflation and rising rates in bonds. Bonds were on a winning streak from the end of 1981 through to the summer of 2020, with prices rising as yields fell. Today, the dynamic is changing as fixed income markets witness the end of a 40-year bull market run in bonds. This regime change is a double-edged sword. Rising bond yields are accompanied by falling prices, as bond prices and yields have an inverse relationship. Investors buying bonds today will get paid a higher rate of interest than they would have in the recent past. Investors holding bonds today are seeing the value of their holdings decline. Over the course of the second quarter, and notably in June, elevated recession fears led to a widening of credit spreads as investors demanded higher compensation for the increased likelihood of economic deceleration. Despite the spread move, we remain cautious as the market continues to price in slowing economic data and pressures central banks to keep raising interest rates to fight inflation. Fed Chair Powell forcefully reinforced our view during his Jackson Hole speech, in which he underscored the Fed's focus on reducing inflation. In this environment, our managers are incrementally adding risk within their portfolios, although they remain cautious with the view that a more attractive entry point should arise in the near term. Managers are closely watching spread levels along with current economic and corporate fundamentals at the technical backdrop. They're taking advantage of buying opportunities in banks with healthy balance sheets while also targeting shorter maturity financials, meaning less time until principal is repaid. Our positions. In this environment, broadly speaking, SEI's fixed income portfolios are positioned with a modest overweight to the spread sectors, which is providing a yield advantage to the funds. This noted, we remain cautious and very selective on where we hold risk, generally favoring front-end corporates and securitized debt. Neutral duration in short to limited term U.S. strategies, which has increased from an underweight as Treasury yields pushed higher. Within our U.S. core portfolios, we continue to hold a marginal overweight to duration, with tactical adjustments applied as interest rates exhibit short-term fluctuations. We generally remain underweight European and UK duration within our global and international fixed income portfolios with a tilt to the emerging markets. When evaluating the state of the market, we believe central bank intervention is a consideration and must be taken into account. Looking at historic periods, the US Federal Reserve stepped in with lower interest rates and flooded the market with liquidity during times of economic stress. As a result of that intervention, the spread of investment-grade corporate debt decreased dramatically, as most recently observed during the pandemic period. Thanks again for your time. Stay tuned for our next piece on individual bond strategies.